To borrow or not to borrow? Let's discuss 6 common questions you may have on government debt. Question number 1. Why does government borrow money? When government spends more than what it collects in revenues, it incurs a deficit that is financed by borrowings or debt. The Philippine government has consistently incurred a deficit in recent years. The last recorded surplus was way back in 1997, when government had to arrest rising debts brought about by the Asian financial crisis. Question number 2. Who lends government money? Government borrows money by either issuing bonds to domestic and external commercial investors and sometimes the Bangko Sentral ng Pilipinas, or entering into loan agreements for official development assistance with multilateral and bilateral institutions. The increase in Philippine government debt in the past decade has mostly been financed by commercial debt. More than 85% of the Philippine government's outstanding debt is in the form of bonds held by financial investors such as banks, pension funds, and even retail investors. Official development assistance has continued to be a source of debt, but its share of the outstanding debt has been decreasing. ODA are funds offered by international development agencies at concessionary or lower than market interest rates in pursuit of development objectives. The Philippines' top sources of ODA are the Asian Development Bank, the World Bank, and the Japan International Cooperation Agency and the Japan Bank for International Cooperation. Question number 3. Why is borrowing mix important? Borrowing mix refers to the different currencies in the government's outstanding debt portfolio. The government issues bonds in pesos and in dollars, as well as enters into loan agreements in yen or euros. Conventional thinking is that the more the debt is denominated in pesos, the better, because government tax collections are in pesos. Thus, government is less susceptible to foreign exchange rate fluctuations. For this reason, some push for a full peso-denominated debt, but others argue that it is important to maintain a global investor base to ensure continued access to foreign financial markets. More than 66% of Philippine government debt is now denominated in pesos. Question number 4. Is it bad to borrow more? Well, more is relative to one's income or ability to pay. A ₱1,000,000 loan might be too much for a student with no or minimal income, but for someone like Bill Gates, it might not be that much. The purpose or use of the debt also makes a difference. It's one thing to borrow money to buy a fancy new car, it's another to use it to start a new bakery business. In judging whether a country's debt is too high, it's important to consider a country's income or its ability to pay as measured by its GDP, and how the debt is used and if it increases future GDP. In the case of the Philippines, while total outstanding debt has continuously increased, as a proportion of Philippine GDP, the debt ratio has actually decreased. Because the country has become richer, it can take on more debt. Debt can be thought of as funding present-day expenses using future tax collections. It's essentially taking money from future taxpayers and using it in the present. If this leaves future taxpayers worse off, then it's like stealing from them. If it leaves future taxpayers better off, then it's a worthwhile investment. For those who oppose more debt, crowding out is also another problem they cite. Crowding out happens when too much government borrowing runs after limited savings in the financial markets, leaving less funds for private companies to borrow for their own investment spending. Question number 5. Why do credit ratings matter? Credit rating agencies, the most popular of whom are Fitch, S&P, and Moody's, assess a borrower's ability to pay back debt and the likelihood of default. The credit rating provided by these agencies is supposed to provide information to possible investors of bond issuances. The riskier the borrower, the higher the interest rates lenders will charge. The lower the risk of default of a borrower, the lower the interest rate. And the lower the interest rate, the more resources can be channeled to productive investments rather than debt payments. While Philippine interest payments have been relatively flat throughout the years, as a percent of national government expenditures, they have been decreasing. This is good news because it means that we are able to spend more for meaningful expenditures. Question number 6. Why track contingent liabilities? Contingent liabilities are potential losses that may occur in the future depending on the outcome of a specific event. Unlike future interest payments, which are already certain, contingent liabilities are not. These are future payments that may arise from failure to meet contractual obligations or expenditures that government might have to shoulder if the responsible institutions are unable to do so, such as pension or health insurance. These need to be tracked so that government can make the necessary interventions early on so that contingent liabilities do not materialize.